Look, so far most of the results are coming in line with expectations. Of course, there are a few surprises on the upside and downside, but overall the results are confirming what we've been expecting for corporate Australia and the broader economy. Looking for earnings growth of the market as a whole this financial year of around mid-single digit.
And how about the companies? What have been the standouts for you so far?
Well, investors, of course, in this market are interested in the banks and the miners. Firstly, on the banks, Commonwealth Bank is the only major bank to give a full year result this reporting season. The others don't report till the end of October or early November. What we're seeing from Commonwealth Bank is reasonable asset growth, good cost control, and a very benign environment for bad debts with interest rates this low. So yet another strong result from CBA. However, the stock's marginally expensive because it's so popular for its fully franked dividend yield in this very low interest rate environment.
And for the miners?
So different capital management outcomes with the miners. Rio Tinto chose to divert its free cash flow into a double-digit hike in its interim dividend. BHP disappointed on its dividend and also expectations for a buyback. Instead, we're getting the major demerger, which will see the unwanted assets spun off. I think it's interesting that BHP is retaining its thermal coal, but spinning out its metallurgical coal, which is consistent with our view that the thermal coal prices and stocks have broadly bottomed around these prices.
Now, one of the big things out of this earnings season has really been the idea of capital management. The companies are looking at their balance sheets and working out what they can give back to shareholders rather than pursuing a growth strategy.
Yeah, they're under pressure from investors, especially SMSF investors in pension mode in a very low tax environment, to increase dividend payout ratios and pay out more and more in dividends. Now, this might be fine now, investors get a high dividend now, but because companies are reinvesting less in growing their businesses, it means a smaller dividend in the future. There's a trade-off going on here that investors and directors need to understand. In the case of Telstra, a small buyback, possibly to burn bridges with investors burned by earlier sell downs. This was a small buyback. It's a little bit above our valuation, so it's slightly dilutive. The better approach is to sell shares on market, we think, than to tender shares into the buyback and only get a few accepted.
Now, so many shareholders are actually chasing yield and they are getting some capital gains with that too, but there are still some traders out there and some of those were caught out in a short squeeze, weren't they? A
couple of examples. Firstly, cochlear and surprisingly QBE. We upgraded our valuation on QBE from $8.91 to $10.04 because we think some of the risk is coming out of it for two reasons. Firstly, the equity raising de-risks the balance sheet by improving regulatory capital multiples and reducing gearing. But also as time goes on and QBE takes these hits, these are disappointing now, but they're going to result in better underwriting performance going forward. There was extra reinsurance over the European medical malpractice book, and also QBE has now provided adequately against its workers' compensation book in Argentina. So the market is starting to recognise this, and we think that's why QBE shares gapped 6% higher when they came out of their trading hold for the equity raising post the result.
But the other one, of course, was Cochlear, who jumped 7% after its profit results.
Another short squeeze. The hedge funds got it wrong on that one. Some of the new product momentum has returned to Cochlear after a slow couple of years, and so management's guidance for the future was fairly upbeat.
Finally, David, so you are stocks in value. I mean, when you look at the market, is there still value to be found there?
Look, the market overall is about 5% overvalued, so not a screaming sell, but not undervalued either. So that's an aggregate measure of it being still fairly difficult to find value at the individual equities level. There are pockets of value which we advise on. There's a handful of small caps, a handful of large caps. But overall, it is difficult to find value. Investors need advice, and it's important to act quickly in the market on the day when value is spotted, because other investors tend to see it also and remove that value quite quickly.
Have to move fast. David Walker from Stocks and Value, thanks very much.
It's my pleasure, Jackson. Thank you.